Most people believe cash is the safest place for their money. After all, cash doesn't crash overnight. It doesn't make alarming headlines. It doesn't swing wildly from one day to the next. It sits quietly in a savings account, giving us a sense of certainty in an uncertain world. And that feeling of certainty is powerful. In fact, for millions of Americans, keeping large amounts of cash in the bank feels responsible. It feels prudent. It feels like the kind of decision financially wise people make. But what if that feeling is misleading? What if the habit that feels safest is quietly making you poorer every single year? Not through a dramatic market crash, not through a bad investment, not through fraud or financial mistakes, but through something far more subtle, something that happens so slowly most people never notice it. Inflation, the hidden force that silently reduces the purchasing power of every dollar you own. And the uncomfortable truth is that many people spend decades protecting their money from the wrong dangers while leaving it exposed to the one threat that affects almost everyone. According to legendary investor Warren Buffett, inflation acts like a hidden tax. It takes purchasing power away from savers without sending a bill in the mail. Jack Bogle spent much of his career teaching investors that preserving wealth is not simply about avoiding losses. It is also about ensuring your money continues to work for you over time. And Charlie Munger often warned that human beings are naturally drawn toward decisions that make them feel comfortable in the short term, even when those decisions create problems in the long term. When you combine those three ideas, a troubling picture begins to emerge. Many people are not losing wealth because they are reckless. They are losing wealth because they are too comfortable. Today, we are going to explore the hidden cost of keeping too much cash. More importantly, we will explore 6 types of assets that investors have historically used to protect purchasing power and build wealth across generations. This is not about getting rich quickly. It is not about predicting markets. And it is certainly not about chasing the latest financial trend. It is about understanding one of the most important principles in wealth building. Money that sits still for too long often falls behind. And by the end of this video, you may never look at your savings account the same way again. Imagine a retired couple living in Ohio. They spent decades doing everything they believed was right. They worked hard, avoided unnecessary debt, saved consistently, raised a family, and by retirement, they had accumulated $250,000 in cash savings. They felt secure. In fact, they felt proud. That money represented years of sacrifice, years of discipline, years of saying no when others said yes. Then something unexpected happened. Prices began rising faster than they had seen in years. Groceries became more expensive. Yearly bills increased. Insurance premiums climbed. Medical expenses grew. Travel costs rose. Even simple everyday purchases seemed noticeably higher. At first, the changes appeared small. A few extra dollars here, a slightly larger bill there. Nothing dramatic. But over time, those increases compounded, and slowly they realized something disturbing. Their bank account balance looked almost the same, yet the lifestyle that money could support was shrinking. The numbers hadn't changed very much, but the value had. This is one of the most misunderstood concepts in personal finance. Most people focus on the amount of money they have. Wealthy people often focus on what that money can actually buy. There is a huge difference. If you have $100,000 today, and 10 years from now you still have $100,000, it might appear that nothing has changed. But if prices have increased substantially during those 10 years, your purchasing power may have fallen dramatically. In other words, the number stayed the same. The value did not. And that brings us to one of the biggest illusions in modern finance. The illusion of safety. Cash absolutely serves an important purpose. Everyone needs emergency savings. Everyone needs liquidity. Everyone needs money available for unexpected expenses. The problem is not owning cash. The problem is believing cash alone can build long-term wealth. Historically, cash has been one of the weakest long-term stores of purchasing power. That statement surprises many people because cash feels safe. Yet when economists study financial history, they repeatedly discover the same pattern. Over long periods, inflation steadily reduces the value of idle money, not all at once, not dramatically, but relentlessly. Charlie Munger once described the power of compounding as one of the most important forces in finance. What many people fail to realize is that compounding works in both directions. Good decisions compound. Bad decisions compound. Investment gains compound, and inflation compounds too. Imagine inflation averaging just 3% per year. That may not sound alarming, but over decades, its impact becomes enormous. The purchasing power of money gradually erodes. A dollar today buys less tomorrow, and less the year after that, and less the decade after that. This is why so many wealthy families think differently about money. They do not simply ask, how can I protect my money? They ask, how can I protect my purchasing power? That subtle difference changes everything, because once you understand the real enemy is not volatility but erosion, your entire perspective begins to shift. Jack Bogle understood this. Warren Buffett understood this. Charlie Munger understood this. And wealthy families across generations have understood this as well. They recognize that money is not supposed to sit idle forever. Money is a tool designed to create more value, a tool designed to own productive assets, a tool designed to preserve purchasing power across time. The challenge is that many people confuse stability with progress. A savings account may feel stable, but stability alone does not create wealth. And nowhere is this more visible than during periods of elevated inflation. When inflation rises, every dollar must work harder simply to maintain its value. If your money is growing slower than inflation, you may technically be earning interest. But in real terms, you are losing ground. And that brings us to the first asset class investors have historically used to fight back against purchasing power erosion. Not because it is perfect, not because it always goes up, but because it has served a unique role for thousands of years. Precious metals, gold in particular, occupies a fascinating place in financial history, long before stock markets existed, long before retirement accounts existed. Long before modern banking systems existed, human civilizations viewed gold as a store of value. Empires rose and fell. Currencies came and went. Political systems changed, yet gold remained. That historical resilience is one reason many investors continue allocating a portion of their portfolios to precious metals today. The appeal of gold is not that it generates income. It does not. The appeal is that gold cannot be printed by governments. Its supply grows slowly, and during periods of economic uncertainty, investors often view it as a form of financial insurance. Warren Buffett has sometimes criticized excessive enthusiasm surrounding gold because it produces no earnings. Yet even Buffett has acknowledged that inflation can severely damage purchasing power. For many investors, gold serves a specific purpose, not growth, protection. That distinction matters. The goal is not to replace productive investments. The goal is to complement them. Silver occupies a slightly different role. Unlike gold, silver benefits from both investment demand and industrial demand. It is used in electronics, solar technology, medical applications, and numerous manufacturing processes. Because of this dual role, silver often behaves differently than gold. It can benefit from both economic growth and inflation concerns. Again, this does not make it risk-free. Nothing is risk-free. But understanding why investors hold these assets helps explain their enduring popularity. The broader lesson is not about gold itself. The broader lesson is about diversification. Wealthy investors rarely depend on a single asset class. They build resilience through diversification because no one knows exactly what the future will look like. And the ability to adapt often matters more than the ability to predict. The mistake many people make is assuming wealth preservation requires finding one perfect investment. History suggests something different. Successful investors usually focus on balance. Balance between growth and safety. Balance between risk and stability. Balance between present needs and future goals. And as we move to the next asset class, that principle becomes even more important, because while precious metals may help preserve purchasing power, the next category has historically done something even more powerful. It has created wealth. And that difference changes everything. If precious metals are often viewed as a shield against uncertainty, the next asset class serves a very different purpose. It is not primarily about preservation. It is about production, because one of the greatest wealth-building discoveries in modern history is surprisingly simple. The people who build lasting wealth are usually not the people who work the hardest. They are often the people who own productive assets. That distinction changed Warren Buffett's life, and it may change the way you think about money as well. Imagine two individuals. The first saves every dollar possible and stores it in cash. The second uses a portion of their savings to acquire ownership in productive businesses. At first, their financial situations look similar. Both are disciplined. Both are responsible. Both are patient. But over time, something remarkable happens. The business owner begins benefiting from forces that the cash saver never experiences. Revenue growth, profit growth, innovation, productivity improvements, rising demand, economic expansion. Instead of simply holding money, they own something that actively works on their behalf. This is one of the core ideas behind Warren Buffett's investing philosophy. When Buffett buys a stock, He does not view it as a ticker symbol. He views it as ownership in a real business, a business with customers, employees, cash flow, and the ability to generate profits. That perspective is incredibly important because once you understand that investing is ownership, markets begin looking very different. The goal is no longer predicting what prices will do next month. The goal becomes owning productive assets for years and decades. Historically, businesses have possessed something cash does not, the ability to adapt. When inflation rises, strong businesses often increase prices. When economies grow, strong businesses often grow alongside them. When demand expands, strong businesses often benefit. Cash simply sits still. Businesses evolve. And that difference has enormous implications for long-term wealth creation. One category of productive businesses deserves special attention. Dividend-paying companies. These are businesses that distribute a portion of their profits to shareholders. In other words, they pay investors for ownership. Think about that for a moment. Instead of relying solely on price appreciation, investors receive a stream of income generated by the business itself. This is one reason dividend investing remains popular among retirees and long-term investors, not because dividends are guaranteed, not because every dividend stock succeeds, but because quality businesses often create multiple sources of return. Capital appreciation, income, and compounding the combination can be powerful. A company that consistently generates profits and consistently rewards shareholders possesses characteristics many investors value during uncertain economic periods. And this brings us to a lesson Charlie Munger frequently emphasized: avoid complexity whenever possible. Many people assume successful investing requires discovering obscure opportunities, high stocks, accurate strategies, complex systems. But Munger repeatedly argued that extraordinary results often come from ordinary decisions executed consistently. Owning productive businesses falls into that category: simple, boring, unexciting, yet historically effective. However, there is one challenge. Not everyone has the time, interest, or expertise required to analyze individual companies. Most people have careers, families, responsibilities. They cannot spend hours evaluating earnings reports and balance sheets. Fortunately, there is a solution that dramatically changed investing for ordinary Americans, and it happens to be one of Jack Bogle's greatest contribution DICSIM funds. To understand why index funds matter, imagine trying to predict which single company will dominate the future. Will it be a technology giant, a healthcare innovator, a manufacturing leader, an energy company? The truth is, nobody knows with certainty. History is filled with companies that once appeared unstoppable, but later faded into irrelevance. Jack Bogle recognized this reality. Rather than trying to identify future winners, he proposed something radically simple: own the market. Instead of betting on a handful of companies, own hundreds or even thousands. Instead of chasing predictions, embrace diversification. Instead of paying high fees for active management, keep costs low. At the time, many people dismissed the idea. It seemed too simple, too boring, too ordinary. Yet over the decades, index investing transformed the financial lives of millions of people. Why? Because Bogle understood something most investors overlooked. The biggest obstacle to investment success is often not the market. It is investor behavior. People chase trends. People panic. People react emotionally. People constantly search for shortcuts. DICSIM funds remove many of those temptations. And the results have been remarkable. For many investors, index funds provide exposure to productive businesses across the entire economy: technology, healthcare, consumer goods, financial services, manufacturing, energy, transportation. Instead of depending on a single company, investors participate in the collective growth of thousands. This approach aligns beautifully with one of Charlie Munger's favorite observations. The big money is not in the buying and selling. It's in the waiting. Patience, not excitement. Patience, not prediction. Patience, not complexity. The more you study successful long-term investors, the more often this pattern appears. They focus less on timing and more on ownership, less on headlines and more on fundamentals, less on daily movements and more on decades. But there is another reason many people fail to build wealth, and it has nothing to do with investments, nothing to do with inflation, and nothing to do with markets. In fact, it may be the most expensive financial mistake of all. Most people dramatically overestimate their ability to predict the future. They wait for the perfect opportunity, the perfect market, the perfect economic conditions, the perfect moment to invest. And while they wait, years pass, opportunities pass, compounding passes. Charlie Munger often pointed out that avoiding mistakes is sometimes more important than chasing brilliance. Waiting endlessly for certainty is one of those mistakes. Because certainty rarely arrives, there is always another reason to postpone action. Another headline, another concern, another prediction, another fear. Meanwhile, disciplined investors continue moving forward slowly, consistently, methodically. And over time, that consistency becomes a tremendous advantage. This brings us to a crucial realization. Wealth creation is not primarily about finding the perfect asset. It is about participating in productive systems. Businesses create value. Innovation creates value. Economic growth creates value. And investors who own productive assets often benefit from that value creation. Cash alone cannot do that, which leads us to an important question. If productive assets help create wealth, what role should safety play? Because preserving wealth still matters, especially during uncertain economic periods, especially for retirees, especially for those approaching major financial goals. And that is where our next asset class enters the picture. An asset class that may not generate headlines, an asset class that may never become exciting, yet one that has played a critical role in wealth preservation for generations, government-backed securities. And understanding why sophisticated investors continue using them may completely change how you think about risk. Government-backed securities rarely generate excitement. You probably won't hear people discussing treasury bills at dinner parties. You won't see dramatic headlines celebrating a government bond, and you certainly won't find social media influencers claiming treasury notes will make you rich overnight. But that is precisely why they deserve attention. Sometimes the most important financial tools are also the most boring. And throughout history, boring has often been surprisingly effective. When investors purchase treasury securities, they are essentially lending money to the government in exchange for interest payments and the return of principal at maturity. Now, no investment is entirely risk-free, but government-backed securities have traditionally been viewed as among the most stable financial assets available. For retirees, conservative investors, and those approaching major financial goals, stability matters, because wealth building is not only about growth, it is also about preservation. Warren Buffett once explained that risk comes from not knowing what you're doing. The challenge many investors face is that they assume every dollar must always pursue maximum returns. But sophisticated investors think differently. Different dollars often have different jobs. Some money is designed for growth. Some money is designed for protection. Some money is designed for liquidity. And understanding those distinctions can dramatically improve financial decision-making. A young investor with decades ahead may prioritize growth. A retiree living off investments may prioritize stability and income. Neither approach is automatically right or wrong. The key is alignment. The purpose of an investment should match the purpose of the money. This is one reason balanced portfolios have endured for generations. They acknowledge an uncomfortable reality. Nobody knows exactly what will happen next, not economists, not television experts, not market commentators, and certainly not social media influencers. Jack Bogle frequently reminded investors that humility is an important part of successful investing. The future is uncertain. Therefore, portfolios should be resilient enough to survive different outcomes. And resilience brings us to another asset class that has protected wealth across generations. Real estate. Few assets occupy such a unique place in human history. For thousands of years, land has represented opportunity, shelter, commerce, agriculture. Community and economic activity, the world changes, technology evolves, industries rise and fall, yet people will always need places to live, work, shop, and gather. This enduring demand helps explain why real estate has remained an important component of wealth building for centuries. But there is an important distinction many people miss. The goal is not simply owning property. The goal is owning productive property. A vacant building generates little value. Productive property generates income. That difference matters because income-producing assets often possess characteristics that help investors navigate inflationary environments. Rents may increase over time. Property values may adjust over time, and income streams may evolve alongside economic conditions. Again, none of this is guaranteed. Real estate experiences cycles. Property values fluctuate. Local markets vary dramatically. Yet historically, real estate has often played an important role in long-term wealth creation. One reason is leverage. Used responsibly, leverage allows investors to control larger assets with smaller amounts of capital. Used irresponsibly, leverage can become dangerous. Charlie Munger repeatedly warned about the destructive potential of excessive debt. The lesson is not that leverage is inherently good or bad. The lesson is that discipline matters. Financial tools amplify behavior. Good behavior benefits. Poor behavior suffers For many modern investors, real estate investment trusts, or REITs, provide another path. REITs allow individuals to gain exposure to commercial real estate without directly owning buildings, healthcare facilities, warehouses, apartments, office properties, data centers, shopping centers. The underlying assets may differ, but the principle remains the same: ownership of productive real estate. And that brings us to our final asset category, alternative assets. This category receives enormous attention, sometimes deservedly, sometimes not. The truth is that alternative assets are often misunderstood. Some alternatives have genuine long-term value. Others are little more than speculation disguised as opportunity. The challenge is learning the difference. Throughout history, rare collectibles have occasionally preserved value. Fine art, rare books, vintage automobiles, certain historical artifacts. These assets derive value from scarcity and demand. But they introduce unique challenges: liquidity, dehydration, storage, insurance, finding buyers. Most investors underestimate these complications. This is why Charlie Munger consistently encouraged people to stay within their circle of competence. If you do not deeply understand an asset, caution is usually wise. The purpose of alternatives should not be excitement. The purpose should be diversification. And for many investors, alternatives may play only a small supporting role rather than a central one. At this point, you may have noticed a pattern: gold productive businesses, Dike funds, government securities, real estate, selective alternatives. These assets may look different, but they share a common characteristic. They attempt to preserve or increase purchasing power over time. And that brings us back to the real issue. Cash itself is not the enemy. Excessive cash is. That distinction is critical because many people misunderstand this conversation. The goal is not eliminating cash. Emergency funds remain essential. Liquidity remains important. Financial flexibility remains valuable. Cash provides peace of mind. Cash helps navigate unexpected expenses. Cash creates options. The problem begins when fear convinces us to hold far more cash than we actually need. This is where psychology becomes incredibly important. And perhaps this is where Charlie Munger's wisdom becomes most valuable. Human beings naturally seek comfort. We seek certainty. We seek control. Cash provides all three. A savings account balance feels tangible, little predictable, reassuring. But wealth building often requires accepting a certain degree of uncertainty, not reckless uncertainty, not gambling, not speculation, constructive uncertainty, the kind that comes from owning productive assets over long periods, the kind that comes from allowing compounding to work, the kind that comes from trusting disciplined processes rather than short-term emotions. This is where many investors struggle because emotionally, cash feels safer than investing. Yet historically, the opposite has often been true over long periods. Cash protects against short-term volatility. Productive assets help protect against long-term erosion. Understanding that distinction may be one of the most important financial lessons a person can learn. Jack Bogle understood it. Warren Buffett understood it. Charlie Munger understood it. And countless financially successful families have understood it as well. They did not focus solely on protecting money. They focused on protecting purchasing power. They recognized that wealth is not measured by account balances alone. Wealth is measured by what those balances can actually accomplish: the ability to support a family, the ability to retire with dignity, the ability to help children and grandchildren, the ability to weather uncertainty without fear, the ability to create choices, because ultimately that is what financial freedom really means. Not luxury, not status, not impressing strangers. Choices: the freedom to spend your time the way you choose, the freedom to support the people you love, the freedom to live according to your values. And preserving purchasing power is an essential part of protecting that freedom. So as you think about your own financial future, ask yourself a simple question. Are you protecting your money? Or are you protecting what your money can do? The difference may seem small, but over years and decades, it can change everything. If you found this discussion valuable, leave a comment below and tell us. Which asset class do you believe offers the best protection against inflation, and why? Your experience may help someone else think differently about their financial future. And if you enjoy calm, timeless lessons about wealth building, investing, retirement, and financial freedom, consider subscribing to Quiet Wealth Method, because wealth is rarely built through one extraordinary decision. It is built through hundreds of ordinary decisions repeated consistently over time. And the future you want financially may depend less on what you earn and more on what you choose to own.